Well, we got about 40 minutes left and we're buying dips. Apple is 2 cents away from going positive on the day. Let's talk some more about what we learned from earnings and what comes next for the stock with Kyle Balkissoon, portfolio manager of the Hennessy Stance ESG large cap ETF. Kyle, thanks for being here this afternoon.
Thanks for having me.
Appreciate it. Apple stock about to turn positive on the day, so I guess this wasn't too bad of an earnings.
I mean, the earnings for Apple were kind of interesting in that we saw a revenue beat, a slight one, an earnings beat. And you think about that, one of the world's largest companies continues to show growth. That's very interesting. We are currently long the stock because for a couple key reasons. First and foremost is that we expect to see still growth. We still think there's room to grow in terms of top line. We think Apple's very good at preserving their margins. We expect the story to continue unless we're given information to the contrary. And I'd say us and the market and consumers tend to like their products. And the Vision Pro, while we don't expect it to do much from a segment growth standpoint in the near term, we do potentially see that as an opportunity.
Let's remind the structure of your guys' fund, ESG focus, quantitative sort of in a way, but you still have some discretion. How does that work in terms of what you can change within the fund?
I personally can't change anything. So we're fully systematic in that we have to have two convictions. One is that we believe that a name is better than their peers from a values alignment or ESG standpoint. And two is that our models think a name will outperform. We tend to focus more on what we call the quantamental side of quantitative or machine learning driven investments, meaning we try to model out expected sales growth, relative value in the sense of what a company is worth, where the earnings are going to be, and we tend to use our own in-house estimates to guide that.
Okay. The role of Apple right now in the fund is lower than in the broader market, right?
Correct, but that's more of a risk issue in that we cap our max weights out of kind of on rebalance at around 3.5%. That's Bill Davis and I, my co-PM, are of the very firm belief that you shouldn't be putting more than 3.5% into a name, regardless of what the S&P is doing or not. We think it's a very dangerous spot if you have a handful of names at like the 5 or 6%, in that you can get whacked. There could be antitrust, there could be some major issue, and we just view that as too much of a risk from a fiduciary standpoint.
Okay, so it can float above that level in between rebalance periods if the stock really goes nuts. It seems like you guys have right now a pretty strong representation of trades related to travel and consumer. I know one of the stocks you like is Hilton, so I kind of want to branch out beyond just this earnings from this week. Expedia is one of your top holdings. Marriott's in there. Is that a coincidence? Is it the way they're running these companies or what?
We think there's a lot of growth in that part of the market. We think there's been talk of revenge tourism and it's showing up in the numbers, but also if you look at the vacancy data, a lot of these places are swamped. We see an excess of demand on the hospitality front, and we think that Hilton, Marriott, and Expedia are going to benefit from that. Anecdotally, airlines have been adding more business class seats in terms of their cabin mix, just because they think the consumer, which they do, have more dollars to spend. And what we're forecasting is, at least at the moment, is more expected top line growth in a bunch of names in that area, and also at the bottom line.
Okay. Hilton versus Marriott, I guess if you got them both in there, you think there's kind of an industry growth like you're talking about, as opposed to like some big competitive gnashing of the teeth?
Yeah, well, we model everything bottom up, and then where we think a name, if a bunch of names in the same industry are going to show very strong growth, in this product, we'll just have them all. I mean, as long as they align with our values, and if the model says, hey, these guys are having excess growth, and excess growth leads to forward returns, therefore we're gonna have them in there. All so right. I think it's not only an industry thing, but it's a timing thing as of right now.
Okay. From this week's representation of earnings, you got Microsoft in there as well. Very cool, Kyle. Thanks. We'll be in touch. Appreciate the stock picks.
Thank you.
Nice. Kyle Balkissoon, portfolio manager of the Hennessy Stance ESG ETF.